The Fed has officially pivoted. After the latest FOMC meeting earlier last week, we learned extremely important data about what the government wants to expect in 2024, which we all know is an election year, meaning there's some incentive for the government to ease on policy. Numerous industrial stocks are now hitting all-time highs, with the Dow Jones having just hit its one last week. The Nasdaq is just shy of less than 1% away from its all-time high, whereas the S&P 500 is on track yet again to score one of its best months since November of 2022. So is this rally truly something to be excited about, or is it another one of those bull traps that many people are talking about? Well, folks, that question is exactly what I'm going to try to address in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. To start things off, folks, let's first understand where we came from and where we are today. Because as you can see, at least for the large cap indices, the ride over the past 24 months has been truly one of the most incredible ones we have seen in market history. With a decline of more than 22% from peak to trough, and now a recovery almost to the 100% retracement of the previous high. This, in my opinion, is truly a result of an unprecedented amount of illiquidity in the stock market, as so many people from the pandemic left the market for good, having seen just how much stocks can go down after you buy them in your retail portfolio. And as it turned out, that not only freaked out retail investors, but particularly also many hedge funds and corporations, as well as insiders who sold in lots in 2022. But now in 2023, folks, the story has flipped itself on its head, where investors and early stage funds who are seeing value in the market's discounted nature, having bid up the prices like crazy, as most retail investors are yet still either holding bags or sitting on the sidelines, resulting in still a lot of lack of liquidity. And as you can see, this is resulting in the top 7 biggest companies having outperformed basically every other company and sector in the S&P 500 by more than a 40% margin, which has historically never happened in modern stock market history. And the reason for that is obviously pretty simple, because the biggest of the biggest companies have the best balance sheets to weather any sort of economic storm we might be facing, because as I'm sure many people have realized, the Fed clearly over-tightened, as inflation has already fallen to 3% less than 24 months after the Fed started raising rates. With the 10-year yield at almost 5%, and delinquencies and bankruptcies at near all-time highs, it's pretty clear that the economy has already slowed down significantly, although not to the levels we saw during the March 2020 crash. And that is good news for the Fed's end goal of potentially getting a soft landing. Because as it turns out, any other outcome would be bad news for markets and the rally we're seeing right now. As you can see, every single time the Fed starts cutting interest rates, on average, with the median of all episodes, we see a significant return and rally in the S&P 500. Whereas 3 out of the 8 cases, when the economy does tend to enter a recession within the following 12 months, markets obviously underperform drastically. Now, it's important to keep in mind that in the latest FOMC, the Fed didn't instantly cut rates. They kept them flat and hinted that next year they would potentially cut them 3 times. Meaning, the middle line you see right there, which is the inflection point, is going to happen sometime in 2024, most likely in the first or second quarter. Markets, as a matter of fact, are expecting almost 6 cuts in 2024 because they obviously know the Fed is always underplaying exactly what is going on in the economy. And as we all know, inflation falling has a significant lagging effect on actual prices falling, which is exactly why consumers could still be at a big risk next year, which is something the Fed doesn't want to do, especially since we have an election coming up. Election years, as a matter of fact, are some of the most bullish years for broader markets, not even considering the fact that interest rates have such a long way to go down to the average levels that we saw from 2009 all the way up to even the 2019. And well, what kind of stocks have the most to catch up in this new pivot cycle? Look no further than the highest shorted and the smallest of smallest companies, which, as you can see, just over the past month have outperformed drastically what the S&P 500 has been doing. As you can see, after the December 1974 Fed pivot, it was the small cap asset sector that had the highest annualized total returns compared to value, REITs, growth, energy, or even cash and inflation, which is something that rhymes extremely well with what we're experiencing right now. Because back then we had essential runaway inflation and a Fed that had to act quickly to mitigate it at the expense of the broader economy. And even though the economy entered a recession, stocks still performed extremely well from 1975 up until 1980. So is this the pivotal moment that we've all been expecting? Let me know your thoughts on the situation, folks, down in the comment section below. Thanks a lot for watching, and I'll catch you guys in the next one. Take care.